risk and return fundamentals. Here we will master the essentials of property investment risk management and return optimization in this comprehensive lecture. Have you ever jumped into a property deal only to see values plummet or rents dry up unexpectedly? Without understanding market cycles, vacancy risks, and the power of leverage, your investments can quickly turn from profit to problem. But when you master risk and return fundamentals, anticipating boom and bust cycles, structuring leverage responsibly, and navigating regulations, you will ride the waves instead of getting washed out. You will build a portfolio that weathers downturns and maximizes gain. So let's go through a step by step understanding of market cycles. Step 1 is where we understand market cycles. That starts with expansion, rising prices, strong demand, and easy financing. Peak, market overheats, yields compress, then it goes to contraction, prices plateau or decline, and vacancies rise. Then you have trough, values bottom, best buying opportunities emerge. For an example, Dubai's 2014 to 2020 cycle, 2014 to 2015 expansion, luxury tower launches in Dubai, downtown Dubai, prices surged 20% year on year. 2016 to 2018 contraction, oversupply led to 10 to 15% price declines and rising vacancies. 2019 to 2020, it was a trough, values bottomed, government stimulus and Expo 2020 pipeline spurred stabilization. Step 2. Assess vacancy risk. Measure vacancy rates. Track vacancy percentage in your submarket via portals like Bayut or Zillow. Lease structures. Long-term leases 3 to 5 years in commercial reduce turnover risk. Buffer assumptions. If in your pro forma, assume a 5 to 10% vacancy for residential and 10 to 15% for commercial. Practical tip, when underwriting a Dubai Marina villa, use a 8% vacancy buffer, even if current listings show 5% vacancy, to guard against market swings. Step 3, leverage wisely. Loan to value. Higher LTV boosts cash on cash returns, but increases risk if prices fall. Then you have debt service coverage ratio. Ensure that the debt service coverage ratio is greater than equal to 1.25 to maintain the cushion. Stress test rates. Model interest rates increase of 1 to 2% to see impact on cash flow. For an example, a 70% LTV mortgage at 4% interest on a Dubai villa. Now run a scenario where the rate rises to 6% and check if your DSCR stays above 1.25. If it does, that's good. Now navigate regulations. Dubai, RERA caps, Ijari registration, escrow accounts for off-plan. US local zoning codes, building inspections, REIT compliance if applicable. Due diligence, always verify local taxes, transfer fees, 4% DLD in Dubai, and foreign buyer restrictions. Resource, download the RERA investor guide, link in resources for a quick reference on Dubai regulations. In ChatGPT, enter summarize the key inflection points in Dubai real estate market cycle from 2014 to 2024, including boom, bust, and recovery phases. Now, once AI gives you the summary, copy it into your Module 1 workbook. This will form the basis of your next market analysis exercise. Key takeaways: risk and returns are two sides of the same coin. By systematically analyzing cycles, accounting for vacancies, leveraging responsibly, and staying compliant, you turn uncertainty into opportunity. Complete the ChatGPT assignment and save your summary. Post one insight you learned about the 2014 to 2020 Dubai cycle in the discussion forum. And in the next lecture, we'll talk about modern PropTech and AI in real estate. We'll explore cutting edge tools that amplify these risk management strategies. So see you there.